Hello, everybody. Thank you for your patience. My name is Mark. I'm with TB Vets. Thank you for joining our co-hosted webinar today. We do have a guest today. It's Adrian Stewart. He is a chartered professional, is it associate accountant?
Accountant.
Accountant, thank you. And this is co-hosted with CPA Financial Literacy. So they do offer free sessions, which are quite valuable for a lot of different topics. And yeah, that's us. Thank you everyone for joining. If you do have questions throughout, feel free to use either the chat and I will answer throughout. Um, as Adrian will be hosting with slides. Um, Everyone should have got a handout. If you didn't, you're welcome to email me after. It's just mark@tbvets.org. I'll put it up on the screen at the end of the webinar as well. If you have any questions afterwards and you'd like to discuss things, feel free to reach out to me. And yeah, I'll pass it over to Adrian and we'll get started if everyone's ready.
Perfect. Thank you, Mark. Just a quick brief about myself. My name's Adrian Stewart. I'm the founder and owner of Tideline CPA Inc. It's a public practice accounting firm here in BC. I am located in Nanaimo, British Columbia. I was asked by CPA BC to help with this financial literacy program today, and I'm very excited about it. I'm very passionate about the estate planning and making sure everybody's planned and ready for retirement and comfortable with that. And that being said, I mean, there's never a bad time to start. Earlier, later, any time to start is better than ever. As the session goes through, if you have questions, raise your hand. If you click on the hand button, I'll see it and I'll try to stop and answer any questions. And if I don't get to anything, I will leave my information and you can feel free to reach out to me through email or phone call. I believe Mark would have sent it out in the handouts as well. With that being said, I will jump into the presentation because that's a lot of information to go over and we don't have a ton of time. All right, can everybody see that okay?
Yes.
Perfect. I'm just gonna move something around here. Okay, yeah, it's a pleasure to be here with you today to talk about estate planning. First off, and this is always tricky in digital, but how many people, through show of hand on your screen, have actually created a will or started with their estate planning? Perfect. I have a few hands, some thumbs up. That's great. So a lot of this information I'm going to go over, I'm sure when you built your wills or you talked to a professional helping you, would have gone over that. Okay. So we have about an hour together today. You should all have a copy of the presentation as Mark mentioned. If you don't, we'll resend it out, but just follow along with the slides. It's fine. This session is designed to be interactive. So speak up or ask questions if you have it. And one thing, the session is presented by the Chartered Professional Accountants of Canada. CPA stands for Chartered Professional Accountants. Accountants work with numbers to keep businesses honest and successful. CPA Canada is one of the largest accounting organizations in the world, representing more than 210,000 CPAs across the country. Canadian CPAs are recognized and respected across the globe for their knowledge and integrity. Some CPAs work in accounting firms, while others work in industries such as entertainment, sports, technology, nonprofit, and many more. Depending on their specific job, CPAs can be responsible for making sure a business, its financials add up, managing budgets, and developing plans and policies that help grow the business and people's personal lives. All right, that being said, let's get started. So today we're going to talk about estate planning, why it's important, and we'll take a look at some strategies and tools you should consider as you work through the estate planning process. You should have copies of my presentation in front of you. All right. And if there's anything on the agenda that you don't see that's of significant importance to you, maybe write it down. And if we have time at the end of the Q&A, I'll touch base on it or I'll make a note and then I'll send out some notes after the presentation to make sure that we covered everything that's of value and interest to everybody. Oh, what's going on? Okay. An estate plan is an arrangement of your financial affairs designed to accomplish several essential financial objectives. both during your lifetime and on your death. The plan should accomplish the following goals: provide tax efficient income during your lifetime, before and after retirement, provide tax efficient dependent support after your death, provide tax efficient transfer of your wealth, and protect your assets. Estate planning is the process of creating a plan to distribute assets, a plan to take care of the people and things important to you. During your life or upon your death, an estate plan should also include contingency arrangements for the possibility that you may not be able to make decisions at some point in your life, for example, because of a severe injury or a medical condition. Why do it? Well, an estate plan will help ensure that your dependents and beneficiaries have income and assets for their ongoing needs. The loss of your income means that some planning may be needed to determine how it can be replaced. You likely wish your dependents to maintain normal spending patterns without substantially altering their lifestyle when you know you're no longer there to contribute. Another reason for estate planning is to minimize and hopefully avoid family disputes. By planning ahead, you can anticipate issues and discuss the reasoning behind your decisions with family members ahead of time. An estate plan enables you to convey your wishes about how you wish your affairs to be administered, including guardians for your children. If you do not convey your wishes, others such as the government, courts, and those you may not trust may be able to make decisions that you would not agree with. An estate plan helps minimize costs and taxes so that as much property as possible is passed to your heirs rather than being eroded by administrative fees and taxation. It goes with anything being said with contract is once it's in writing, once it's signed off, that's what's going to be followed. So whenever you hear about the messy legal battles over people's wills, over their assets and everything, that's usually because it wasn't written down and nothing was created. Once that's written down and created, you'll have the conversations beforehand anyways, but it just makes life simpler and easier for everybody after. So you don't have to worry about those fights. Okay. So there's many components to an estate plan, and some of the components that your estate plan could include is a properly drafted will is an essential component of any estate plan. That's the legal binding agreement of how everything's distributed. Insurance arrangements, including life insurance, key personal insurance, critical illness insurance, and disability insurance. This will help provide dependent support or fund tax liabilities on your death. Various trust arrangements, spouse trust or family trust, can hold shares for the benefit of others, while they are controlled by a trustee. These arrangements are the primary tools for income splitting and multiplications of the tax-free capital gains exemption among family members and between generations. Where business is a key family asset, a shareholders' agreement will govern the activities of the current and future shareholders by addressing termination, sale, death, divorce, and wealth extraction. Sorry, I'm just noticing some questions came up on the other side of my screen. Just give me a minute. I'm just going to look and see if I should address them now. Okay. Whoa, whoa, whoa. So here's the process. As many of you had mentioned, you've gone through the process of creating your will and starting your estate plan, so this should be fairly familiar to you. But for those who haven't, let's take a look at the actual process. So from a financial perspective, most objectives center on persevering and directing the direct distribution of assets while reducing any tax liabilities, ensuring enough funds are available to meet ongoing needs. At the beginning of the estate planning process, you'll need to examine the complete picture of your current financial status and identify all assets in form of ownership, solely owned, jointly owned, shares in business, etc., as well as life insurance proceeds and potential inheritances. Then you will need to consider strategies and tools to best carry your plan, some of which we'll touch on today. You also need to decide who would like to carry your wishes on your behalf. As you develop your plan, you might find it helpful to consult a professional, such as a lawyer who specializes in wills and estates, to assist with drafting the legal documents involved. The implementation of your plan may also involve moving and transferring of assets and buying insurance. Your estate plan should always be kept current. It is highly recommended that you review and update your estate plan every 3 to 5 years, or any time when a major life event occurs, such as a marriage, divorce, birth of a child, receipt of inheritance, or significant health issues. Why does it keep jumping around? So there are several very valuable tools to consider as you develop your estate plan. These include the power of attorneys, making a will, and the use of joint accounts, gifting trusts, and life insurance. Let's take a closer look at each one of these. So what is a power of attorney? Power of attorney is a legal document that gives someone else the right to act on your behalf. While a power of attorney can be useful, it is also a very powerful document in that it can allow others to act in your name, as if you were making the decisions yourself. Each province has its own laws that govern power of attorneys, so it's best to consult your provincial attorney general's office for more information. The power of attorney becomes invalid when the grantor, the person giving the power, dies. A power of attorney cannot be used to bequeath property upon the death of the donor. When a person passes, the executor, also called a personal representative, appointed in the person's last will and testament, takes control of the deceased person's property and distributes it according to the instructions in the will. A power of attorney is extremely important if a health crisis leaves you unable to handle the business side of your life. So, managing your money, paying bills, or making key life decisions. Even if you're going on an extended vacation or trip and need someone to keep your house in order, a power of attorney can be made effective when you wish for a specific period of time, such as an extended vacation, or it can only become effective immediately after you become incapacitated. A general power of attorney is one that gives the attorney authority to do anything that donor could do themselves. A specific power of attorney is one that gives the attorney authority to act for a particular purpose. Example, to buy or sell a particular piece of property. There are generally two types of power of attorneys, one for your property and the other for your health care. So the power of attorney for health care decisions, sometimes called a living will, is a document in which you write down what you want to happen if you become ill and can't communicate your wishes about treatment. For example, it is quite common for people to write a living will, saying that they do not want to be kept alive on artificial life support or if they have no hope of recovery. They could also say that every effort should be made to prolong their life as long as possible. While some provinces may not recognize instructions contained in a living will, it does provide useful guidance for the substitute decision maker and family members. Please keep in mind that for both of these roles, you need someone very objective or impartial and level headed to make tough decisions. So, before we discuss the importance of preparing a will, let's look at what happens when you pass away without one in place. So, if you pass away without a will, intestate, as this is called, the government will distribute your assets according to a preset formula. It may take some time for the courts to appoint an executor, and until then, your assets will be frozen. Assets that are distributed can be taxed without a proper strategy. Generally, all assets are liquidated, which may not be what your intentions were. The way assets are divided, assets between spouses and children vary by province. Even the definition of a spouse varies and can impact asset distribution. In general, spouses will get all the assets if you do not have any children. But if you do have children, they will likely get a portion. For example, in Ontario, if you pass away without a will and have a spouse and two children, your spouse will receive 200,000 plus 1/3 of the value of the estate over 200,000. Your children will each receive 1/3 of the value of the estate over $200,000. In other words, without a will, you are leaving everything you have worked for to the government to divide up. Assets that are distributed to your heirs may be heavily taxed without proper planning. All right, so making your will. Making your will ensures that your final wishes are carried out in a cost-effective and equitable manner. It is important to have a will regardless of your stage of life, especially after major events such as marriage and or children. As a general rule, it is advisable to hire a lawyer to draw up your will. You should make sure that you get somebody to witness it and that someone knows where your will is located. Often lawyers will provide this service at no charge. While preparing your will, you should also consider having powers of attorney for your property and health needs drawn up as part of your estate plan. It is usually a good idea to tell your family members about your plans. You don't need to mention numbers if you don't want to. Finally, circumstances can change with time. You should review your estate plan and will at least every 5 years or after every significant life event and update it accordingly. Okay, I think before I jump on to the next slide, I'm just going to check the chat. And this might be a good opportunity for any questions on the generalness of the estate planning, of selecting a power of attorney, or any concerns about will. So if anybody wants to write in the chat, and I'll monitor that and then kind of respond accordingly.
Yeah, it looks like we had one. Dorothy actually mentioned that in BC, a representation agreement is used for health decisions compared to power of attorney.
Yeah,
Um,
so that's would be the other consideration to a living will.
yeah,
Is that's how BC has in place. Every province has a separate wording for it, but
mhm.
it all comes down to similar.
Nice. Yeah, if anyone has any other questions, feel free to pop them in the chat.
Yeah, we'll take a couple minutes here,
Yeah,
just as a bit of a break.
yeah. Everyone, take a little water break if you need it.
I need one.
Yeah. Thank you for powering through.
Um,
Yeah.
all right, so I got two good questions here. The first one is, would siblings or other relatives have to be mentioned if entire states to go to the children? My understanding is no. If you're only leaving stuff to your child, like your assets dispersed to your children or direct family members, you only need to name them. One thing that people can run into, and this is a conversation with a lawyer, is if you have multiple children and you leave everything to one child, they can contest that. So if there is an issue with the children, you want to make sure that something's left to each so that they can't be contested. But again, that's a conversation to have with a lawyer. As for non-direct family members, so that'd be siblings, cousins, aunts, uncles. You don't have to name them in the will. Are power of attorneys registered? How do you know if one exists? Yes, power of attorneys are registered. So often that's when you're creating your will or you're doing your estate planning, you would reach out to someone who you want to be your power of attorney, and then the lawyer, well, sorry, something spot up. The legal representative will notify them, or you can notify them, but it is a registered. Okay, there's just a comment on here. Somebody made, I'm not sure if everybody can see this chat, so I'll just read it out. It says, I have also completed a most form with my family physician indicating my wishes regarding health decision. There's no fee involved. So that's a good thing to point out. It's similar with when you're registering, when you're talking to your practitioners, is a lot of the contention is with organ donors. So some people want to donate their organs and they're very so when something major happens, the organs are donated or harvested as soon as possible, where others don't want to donate their organs because they want their life to be saved at all costs. So, perfect. And then there's a link for most forms that somebody just posted on the chat group, which we should all have access to. Okay, I'm going to jump back into the will, but by all means, enter in your questions in the chats or comments. I will take another break after we go through the will and touch base on anything that came up during that time. Okay. My thing keeps jumping around. So Diana, we talked about that. Okay. So next is the important step of selecting an executor. The executor is the person responsible for executing your wishes. This is not an honorary position, so be sure to select a capable individual and get their agreement in advance. Being an executor can be a time-consuming responsibility. Also, one key point to note out is many people do not know that once you pass away, the CRA treats all capital property as if it were disposed of at fair market value, unless it was transferred to your spouse. So there could be significant tax implications on that transfer of property. That's where planning comes into play to help minimize that. So this capital property can include cottages, investments in stocks, bonds, and real estate. If your capital property is appreciated in value since you acquired it, your estate may be forced to pay significant taxes, which reduce the assets available to your beneficiaries. So determining the due date for final returns depends on the date of passing. If your loved one passed between January 1st and October 31st, the final return is due at the normal time of April 30th of the following year. If your loved one passed in November or December, the final return is due within 6 months after the date of death. Special rules apply for self-employed individuals and their spouses. Passing away can be very expensive. So, as part of estate planning and when drawing up a will, it makes sense to take all the expenses and cash needs and cash requirements into consideration to ensure that enough funds are available to provide for these outlays. You may be unfamiliar with one of the taxes listed here, which is the probate fees. Probate is the process of establishing the validity of a will and the authority of the executor. Probate taxes are generally involved when someone dies, intestate, or when an estate includes real estate, assets held by banks and government bonds. Probate fees vary from province to province and are usually based on the net value of the entire estate. Quebec is the only province that does not charge probate fees. There are ways to reduce assets that are subject to probate fees, such as establishing joint accounts, trusts, life insurance, RRSPs. Joint accounts and joint ownership is registering assets under multiple owners. It's one of the simplest ways to transfer assets without paying probate taxes. When one party dies, ownership is automatically transferred to the surviving party. While a useful way to avoid probate fees, other tax and legal issues can arise, and you must be comfortable with the other individual having access and control over the assets. The joint tenancy with right of survivorship agreement does not exist under Quebec law and cannot be used in that province. So you want to be aware of legal issues about using joint bank accounts because the world is ever changing. Joint accounts are a tricky beast other than in a spousal context. And that being said, it's just once you've created that joint account, it's hard to get rid of the other individual that's a part of it. I mean, perhaps the easiest way to transfer assets is to give them away while you're alive. However, gifting assets before death can create tax liabilities. If the asset is capital property, the asset is deemed to be disposed of at fair market value and will trigger tax on any capital gain involved. Transferring money to adult children does not have any tax consequences. However, gifting money to spouse or minor children will trigger attribution rules, which mean that any first generation investment income the spouse or child earns on the gifted money is taxed as if you were the gifter and invested it yourself. First generation income is income originally earned by the spouse or child. However, any second generation income earned on that first generation income is not taxable to the gifter, but is taxable to the spouse or child. Also, capital gains are not attributed back to the gifter, but taxable to the child or spouse. I know that's a lot, so here's a bit of an example. Would be where dividend producing shares are transferred to a child or a spouse, and dividends, which are the first generation income, are used to buy the child or spouse to purchase more shares. So the dividends, second generation income from the additional shares, would be income of the child or spouse. So that way you're using your money, your dividends, to give to the next, to your child or your spouse, who are then taking that money and reinvesting it. So they close that loophole so that can be done. So by the way, you should make sure you don't give away too much because people are living longer. So you may need more than you realize. Also, you must be comfortable with the loss of control. And that's where like a lot of the conversations I have is the loss of control is a big concern of a lot of people when they're planning their estates and their wills and trying to figure out tax plans is it can be very tax effective to gift off or move a big portion of your assets to your living children or your spouse. But there's also the concern, is that individual going to have my best interest in mind still with those funds and assets? So it's always hard conversations that need to be had, but you don't want to avoid the conversations. All right. We'll go into trusts. And then I think after trust, we'll stop and have another break and answer some more questions. So another way to avoid probate taxes is to create a trust. A trust is similar to a will in purpose. Both are designed to allow you to transfer assets to your heirs and beneficiaries. The roles of the trustees and the executor are similar. They're each appointed by you, and each are responsible for managing and distributing your assets to your heirs and beneficiaries. How the assets of the trust are managed and distributed are entirely up to you by including the terms in the creation of the trust. If your estate totals $150,000 to $200,000 or more, the expense of a trust may be worth your while, if only for the fact that a trust will allow you to avoid probate. A trust is a legal entity that you can create to hold various types of assets. Trust can be created while you are alive, called an inter vivos trust, or upon your death through your will, a testamentary trust. Once you transfer your assets to that trust, the trust becomes the legal owner, and the trustee, someone that you appoint, becomes responsible for managing them. Part of the trustee's responsibility is to distribute the income and assets of the trust to the beneficiaries designated by you, in accordance with the terms of the trust. So, benefits of the trust, you might want to consider establishing a trust if your intention is to ensure your assets are managed for the benefit of the beneficiaries. For example, this might be an important consideration if beneficiaries are minor children, as they will likely not have experience in managing their own money. Subject to the rules created for the trust, the person donating assets, the settlor, to the trust could still control the assets of the trust as if they still own them. But since the assets are held in trust for the beneficiaries, the settlor is no longer the legal owner of the assets. So it's worth noting the trust can shield assets from creditors because the trust is a separate legal entity. However, one of the most common goals of a trust is to ensure that wealth is transferred to one's heirs and beneficiaries in the most tax efficient manner by creating opportunities to split income to individuals with lower income and by avoiding probate taxes. An additional benefit of establishing a trust is that it enables you to avoid the public process of probate. A will is subject to probate. The probate application must list all the assets of the deceased and their value. The terms of your will, is available to any member of the public who may be interested in knowing and is willing to pay a small fee. This, however, is not the case with the trust. However, trusts are moving to graduated tax rates shortly, other than some special circumstances. Therefore, how beneficial trusts will be going forward remains questionable. As with most any of our tools and resources we have, it changes semi-annually, annually to shorter periods. All right. So trust is required to file an annual income tax return called a T3, the Trust Income Tax Information Return, within 90 days of the end of its taxation year. However, there are a number of statutory and administrative exceptions to this filing requirement. In the 2018 federal budget announcement, the effective for tax returns filed for the 2021 and later taxation years, additional information reporting will be required on an annual basis for express trusts that are residents in Canada and for non-resident trusts that are currently required to file a T3 return. And a lot of these extra filing requirements are to ensure that there's a money laundering taking place, there's a Transparency Act in place. Yeah, it's just a lot of it's to kind of police and govern the money that's in there. There's a lot of loopholes that us accountants used to be able to use within trusts that have been getting closed off, but there is still a lot of benefit to owning a trust. All right, so our next topic is going to be life insurance. Before we jump onto that, I will check the chat and see what has come about.
Yeah, we had a few questions.
Okay.
back to Olga's question, I think is the
First
first
one.
one. Yeah.
Oops. Okay. What does the term endearing mean? So when referring to a POA and the term endearing, so it's just long lasting. So it's not a short term power of attorney. Um, and you would cancel your POA the same way you set it up. So if you're using a lawyer to establish who your power of attorney is, which is highly recommended, you would just go back to that legal counsel and say, I no longer want to use this individual as my power of attorney, would be my best recommendation. I mean, there is other forms you can use to create your power of attorney, but those would be a little bit trickier to cancel because then you're going to have to go back through that service that provided that form, deregister your power of attorney, and re-register a new one. You used to be able to, I would have to look this up and familiarize it myself, but I know some provinces are sophisticated enough that when you register a new power of attorney, it automatically cancels your past power of attorney. But there was issues with that, so there might be some things to look into, but that's where it's kind of always recommended to talk to a lawyer in that case. So how does it work with the successor with the bank finances and following the will? Does the will have priority? Not sure I fully understand that question with the successor. Um, if you're referring to the successor who's appointed in the will, everything would just transfer to them. Um, yeah, so
It sounds
the will definitely has priority if there's somebody's appointed in the will, um, or the successor, then yeah, the will would have priority for sure because that's your legal demands and wishes. I think I'm yeah, I'm not fully sure of that question, but
I think
hopefully I answered it.
that sounds like that sounds like what they're asking. If
Okay.
we don't have your first name, Marquardt, but if you want to clarify your question, how does it work with the successor with the bank finances? I think what you mean to say is which one has the priority, which sounds like what you were answering, Adrian.
Yeah, because the will would just transfer the legality to whoever's listed in the will as opposed to a successor.
Got it.
The next question is, do all estates need to go through probate? They do if nothing is being put in plan. So if there's no estate plan in, there's no will, there's no trust or anything in there, and it's left up to inundate through the government, then it would go through probate. So that's where some of the things we're discussing today is kind of how to avoid that probate and how to get around it just to reduce the fees that it'd be owing. That's a great question on the GIC. I believe that they wouldn't be considered for probate if it is listed as a joint account. Um, yeah, no, if there's multiple individuals listed on GIC, same with sometimes people have investment portfolios with multiple people, different assets. That's similar to joint account, joint splitting. So it shouldn't be considered for probate. Bear trust agreement. So bear trust forms was essentially information gathering, and there was a lot of pushback on that because nobody's seen any value or purpose for it. So the big CPA Canada was one of the organizations pushing back and saying, why are we asking for a bear trust form? As far as I'm aware, they're not back. I don't know if there's any intention of coming back, but that's speculation on my side. I hope they don't come back because it was a nightmare. Okay, next question. My executor is my power of attorney. She lives out of province. I have no one in BC that I want to take this on. That's fine. Your power of attorney, the executor do not have to be in your same province. One thing is if, and this is very much keep in mind, is if they're out of country, each country has different laws and can handle things differently. So definitely talk to a lawyer on that. I just went through a situation where somebody passed and their executor lived in Britain. And the problem with Britain and UK law is they get taxed extremely heavily on the transfer of assets over to a different country. And just being the executor makes it's a deemed asset thing. So the advice was for the executor to solely be the individual here in Canada. So just keep in mind. But as for province, it's fine. They each have their own little rules. But if they're in Quebec, it's a little bit different. But that's fine. All right. So next question. My niece and two nephews are my heirs. I have money from investments to go to my estate. Or should I have them each named as beneficiaries? That's a great question. If I'm understanding it, so if in your will you have them listed as your beneficiaries, taking that on in your state, then that would be fine. But if you just have them listed as an heir where there's nowhere actually allocating them as a beneficiary, you just want to be mindful of that because somebody could challenge that and contest it. Just one second. Again, I'll keep harping on this, but it's just to do with the planning, making sure it's written down, making sure a lawyer sees it. And then once everything's kind of on paper and contract, it's really hard for anybody to challenge that, contest it, and you can ensure all your assets and everything that you want go to the right people. OOP. Yeah, that's correct. So somebody mentioned in here that I understand that an O out of province executor means the province of residence for probates, fees, etc. So it varies. I mean, each province is going to have its own rules. Sometimes the probate fees and everything is established in the province of the individual that passed, and sometimes it is established in the province or the judiciary area of the executor. So it is something to be mindful of, and again, conversation to have with the lawyer. So here's a great question, and it's a complicated one, but does having a power of attorney separate from another power of attorney complicate things? It can and it can't depending on how it's written. So if you have two power of attorneys, you just need to be very detailed in the paperwork. So if you have someone who's your power of attorney that's solely responsible for making decisions on finances, it just needs to be very clear in that. And if you have a power of attorney that gives someone authority solely on health decisions, you just need to be clear on that. So that's where if one person is in power of attorney, but it's not clear that's solely for the right of the finances in the bank, they might think that they have the right to make the health decisions as well, or vice versa. So it needs to be very, very clear to that POA. But there is many cases where there's multiple power of attorneys for finance and health related reasons. Okay, hopefully I answered most of those the best I could and give everybody the information they needed. And we're going to jump into life insurance. Always a fun topic. I feel like I skipped a slide when I did that. Yes. Okay. Many Canadians should consider having a life insurance policy, especially those with dependents. This is not intended to be a life insurance education session. So if you require additional information, you should consult the life insurance professional. I mean, I have some information on life insurance, how we use it for different tax saving tools, but I'm not a professional by any means. So, purpose of this session, I'd like to share two key messages with you about life insurance. The proceeds of life insurance are paid out tax-free to beneficiary or beneficiaries and avoid any probate taxes. The second point we'll look at on the next slide. So that's key, and that's where a lot of people transfer their wealth is through life insurance. And there's a lot of really good vessels that can be used, and that's where you bring in specialists in life insurance, potentially a lawyer and an accountant, and work it out. I've seen some pretty cool things created. Whoops. Why does it keep skipping? Sorry, my computer's just jumping around on me here. All right. Secondly, life insurance proceeds are typically used for some or all of the following purposes: to maintain the lifestyle of your dependents, for example, your wife and children and their home lifestyle or education, to pay funeral and related expenses, to pay estate income taxes. Critical illness and other types of disability insurance are good to have for unexpected life events that do not end up in death, such as a mild stroke or non-terminal cancer. So you can purchase your life insurance or your critical illness before life insurance. And one other thing, just to touch on, I can't help my accounting brain, is a lot of strategy used on life insurance that I'm seeing a lot of people do nowadays is you can actually borrow on your life insurance policy, usually directly through your life insurance provider. They'll lend up to 80%. So it's kind of a neat tool that individuals can use because your life insurance is guaranteed. So if you want to take out the money personally, so if you have a life insurance policy for say $1 million and you're like, you know what, my kids are fine, they're set, my beneficiaries don't really need the money, but I really want to enjoy my last 10 years, I'm going to borrow $800,000 on my life insurance policy. So a lot of policies will give you that because then once you pass, they'll just take your policy, pay off that debt, and distribute the other amounts. So something to be mindful of there, but little pointer. What did I miss? Oh, no. So here's some tax specific tips. So conducting an annual review of your estate plan will help you prepare unexpected life circumstances. Should also look at or consider freezing the value of your assets and arranging for funds to be set aside or purchasing life insurance to cover the payment of your estimated income tax liability arising on death. There are different types of estate freezes, complete or partial, and stage. Your choice would depend on your particular family situation. Only consider a freeze for assets you expect the family to hold over the long term. Note that income splitting opportunities with estate freezes are limited after 2017 based on the revised tax on split income rules that came into effect. And again, they've removed a lot more opportunities on income splitting. So again, anything always changes. So it's really good to talk to a specialist or an advisor. So review and update your will periodically to ensure it reflects changes in your family status and financial situation, as well as changes in the law. And that's really good advice. I mean, a lot of times I've seen people set up their wills and their plans based on today's taxation regulations, different rules, different laws, but those change yearly. So if you're not changing that in your plan or your will, it might not actually encapsulate what you planned when everything's done. So you want to ensure to weigh the continuing non-tax benefits of using trusts for post-mortem planning, since the tax benefits have been reduced due to the new trusts and the new TOSI rules, which is taxes on split income. An individual may have only one qualifying graduated rate estate that will benefit from the historical testamentary trust advantages. So I know I've covered a lot of information today. Hopefully some of it was valuable. But just to recap, here are the few key ideas from this presentation. Prepare a power of attorney for healthcare and a power of attorney for financial matters, which is part of that question that came up. Maintain an up-to-date will. So 3 to 5 years is a good idea. I would definitely lean on the 3 side, especially if you're noticing things that are coming up in legislation changes that you have in your will. Name an executor. And remember that a good estate plan will help to minimize or avoid income taxes. Avoidance is legal, evasion is illegal. That's a disclaimer I have to say. On your estate and minimize or avoid probate taxes. So here's some tools and resources. Again, you should have these in your notes. But ultimately, it's up to you to take responsibility for your own estate plan and for all your financial planning. It is well worth taking the time to research the topic in more depth. And here you can see multiple resources that you can use, have the conversations with anybody. And really, something that's always missed is have the conversations with the people you intend to be your beneficiaries, who's going to be your power of attorneys, who's going to be executors. Keep those communications in line so that everybody's kind of, there's no surprises. I mean, that's what happens a lot of times is the shock and awe effect. So if you have that conversation, again, you don't need to discuss the money, but you don't want it to happen where if you have two children and all of a sudden one gets 90% and the other one gets 10 or something like that, because then those children might no longer be friends or siblings that want to get along anymore. So, okay. Thank you all for your time today. Again, I really hope that I was able to answer most of your questions and add value. And we have a bit of time here. So if there's any other questions, I will monitor the chat and answer them best I can.
Excellent. Thank you so much, Adrian. We have
No problem.
it looks like three or four questions in the chat.
Okay.
I think starting with Holly.
Yeah, I'm just trying to scroll here. Should the executor and the POA be the same individual? That is completely up to you. Lots of times they are the same person, but other times it's not. Some people use their lawyer as their executor. They use their accountant as their executor. They use somebody that they trust where there's not going to be issues, especially if you have multiple children or multiple beneficiaries. Sometimes they'll feel that it's lopsided because they're executor. I mean, some people use multiple executors on not just personal about myself is my family has named myself and my sister the executor and the power of attorney. So we both have similar roles and responsibilities. So it really is a personal decision. That's more of a question for insurance providers. If I can buy illness or disability insurance after what age? I believe you can buy both up to a pretty late age in life. It just gets more expensive as you get older. So that's one thing. And it's just all going to depend. If you already have a predetermined disability or a predetermined illness, it might be hard to get it. But if you're completely healthy at 90, 95, you probably get insurance on it. It's just going to be very expensive. The sale of a property will be taxed even if beneficiaries are named. That is correct. So the sale of the property will be taxed at market value. So if it goes from your will to them, that's where the taxation comes in. There's no inheritance tax, but it is a disposed asset. So it needs to be treated as such. But the benefit is if it's going to the beneficiaries, then it's staying there. Whereas if nobody's named, then the government just might dispose of that asset and distribute those funds as they see accordingly. And then by naming the beneficiaries, you might be able to get away with changing the value, the market value of the cost. They'll actually look at more of a cost or reduce that capital gain in. So it's a little bit more flexibility to reduce the taxes on it. Here's a good question. Is it better to add children to a vacation property title versus leaving it to them in a will? I mean, by all means, you can. It would eliminate the vacation property transferring to them at market value and disposing to them and creating taxes on it. There can be tax implication on adding them to the property because that would be considered a gift and income to them. But I mean, properties not appreciate, so the sooner you do it, less gain there should be on that. And it can be, sorry, getting dry mouth here. And again, it's part of the planning. So if you're okay adding the property, I always advise people to do it sooner than later because it does give you a better opportunity to save on taxes and you can have the proper discussions with the right professionals at the time being. I'd like my partner to listen to the recording. How can he access it? That's a question for Mark. If he's going to send out the recording, if it was recorded.
Yeah, yes. So this session was recorded. typically the recording gets sent out to all the people that registered by email. So you should get that automatically. And if not, then please just email me. I did post my email in the chat. It's just mark@tbvets.org, but it's in the chat there as well. But
Yeah.
you will automatically get it. So you should get it within a couple of hours of the session ending.
Okay. Yeah, I have some more questions here. I think I got it goes till noon, right? So I still have 9 minutes.
Yeah, you got time.
Cool.
Yeah.
All right. So a question here is what happens if the accountant lawyer has retired and they are the POA? So it really depends if it was the firm named as the power of attorney and the partner at the firm, or if it's just the individual. And that's really up to you. So if you really trusted your accountant and you still want them to be your power of attorney, it's completely fine. Them retiring from their practice won't have any impact on it. But if you're not too sure or they don't want that responsibility because they've retired, sometimes it'll just pass on to their partner successor. So it'd be worth having a meeting with that individual accountant or lawyer that has retired to see if they've passed on that power of attorney or if they're still maintaining it. Okay. Oh, another insurance. So if my wife has a life insurance on her husband, but she dies before the husband, what happens to the value in the life insurance policy? I'm it's That's a tricky question. Dies before the husband. It's almost one of those riddles. Um, would the wife have her own life insurance policy? Because if she did, that would pass to the husband. But if she's holding a life insurance policy on the husband and making the payments and she passes away, I'm assuming the life insurance policy would just stay as is and he would be responsible or the estate would be responsible for making those payments. But that would be a great question for an insurance provider. I did have a couple more questions here from Dawn. What resources are available to people who are finding it difficult to name an executor? I'm pretty sure on that slide there's one that actually showed wills and powers of attorneys, Ontario, Quebec. I mean, a lot of these, because it is CPA Canada, is geared to Ontario. Um, I can try to get back to that, but that's a great one. A lot of law firms that specialize in estate planning and wills will have tool resource kits on their website. So that can be an opportunity there. I mean, my biggest advice for anybody trying to name an executor is you really want somebody who's competent, that understands the intricacies of everything, that understands finances, legalities, and are reliable. Those are kind of my three big ones, but it's competence is the biggest one. You don't want to name someone just because they're good buddies or because that's the child you want to name it. You want that person to actually have the knowledge and the competency to execute it and not be afraid to ask questions of specialists to help them through it. All right. Is it better to gift assets prior to passing or naming a charity as a beneficiary after one has passed? It's a great question. So that's more on the philanthropy side. So if you're going to gift the assets to the charity while you're still alive, then you'll get a tax reduction on your personal taxes. So you'll get your charitable donations. If your estate is solely passed over to a charity of your choice or trust of your choice, and that beneficiary is going to be the charity that's receiving those funds. If there's other people part of your state, they might be able to receive that charitable donation, but it's all really depends on how it was structured. So again, I'm always for planning ahead of time, but you don't want to gift out too many assets before you pass and then not have the availability to those in case an emergency situation comes up. So come up with a plan, lay it out and say, I'm going to be completely comfortable with this much of my estate. The rest I want to gift off to a charity. That's a great plan because then that will actually help reduce some of your taxes owing while you're still alive. Okay. Financial toolkit does not link. Okay, great. Um, Beneficiaries from my RSP may be a little different from the beneficiaries on my will. I presume the beneficiaries from my RSP take precedent. They will, as long as you don't name beneficiaries in your will for your RSP that are different. I would suggest putting in your will and updating it to specify that your beneficiaries are the RSP. I mean, your will, you can pretty much attach anything in there. Like you've seen some really random, odd things, people leaving, sentimental items, anything like that in the will, and different reasons. You can make it as complex or as simple as you want. But for something like that, because it is different, you're right, the RSP would take precedent, but just ensure that I would put it in the will as well, just to make sure. Okay. I'm not sure why the financial toolkit does not work. I'll find a different link and send it to Mark, and then he can forward it out to everybody. I have insurance to pay for any in-home help I may need. If there are any funds remaining after my passing, do they become part of my estate and they're subject to taxes? Sorry. Okay. First quick answer is yes, it will become a part of your estate. But again, life insurance policies aren't taxable. So they wouldn't be taxed on the estate. But they will become a part of it unless there's a specific beneficiary as part of that insurance plan. Again, I take precedence, but again, try to cover all your bases in one document. So I think we have a couple more minutes. What? Memorandum, yeah. That's correct. Yes. So memoranda can be added to a will, which can be changed periodically without creating new wills. 100% correct. The same with appendices. You don't have to redo the whole will every single time. Lots of times they'll just create an appendix C section 1A. We are changing the beneficiary from this individual to that individual. It just makes it, they're not going to rewrite your will every time. They're just going to make the changes that are needed for sure. And again, yeah, no, it was a pleasure to come and talk to everybody today. Hopefully, got a lot of information out of it. You have my information. If you have any additional questions or concerns, please feel free to reach out. I will send a different, I'll try to find a BC financial toolkit and a couple different things to send to Mark, and then he can pass that on to everybody.
Yeah, it's perfect. Once I get that link, I'll just email everyone that was registered. If anyone does have any questions, whether it's for me or Adrian, you're welcome to email me first if that's easier to just remember one email address. Just mark@tbvets.org. And otherwise, if no one has any more questions, I think we could wrap it up. But feel free to put a question in if you have something comes to mind.
Yeah, one more minute, but
Yeah. Well, that was wonderful. So informative. There's so many different angles to come at different things, and I'm sure the questions
well,
just yeah,
it's ever
just so many
evolving. Like
things.
it's
Yeah.
constantly changing.
Yeah.
So, I mean, I read through the legislature at least quarterly because there's always
Yeah.
something that's changed in something. I mean, different provinces, country. So,
Yeah. Yeah. There's lots to keep up with.
yeah.
Perfect. Well, yeah, I think we're okay to end. It looks like everyone is
Yep.
done asking questions, I think.
Perfect.
Yeah.
No,
Thank you,
thank you so
everybody.
much.
Yeah.
And then the disclaimer, but I mean, we're good there.
Yeah. Perfect. Well, thank you so much, Adrian, and thank you to CPA Financial Literacy for this session. It was incredibly
For sure.
informative. Yeah. And thank
Well,
you, everybody.
have
And
a great day,
like I said,
everybody.
if you have any questions, just email me, and you should have the handout as well. If not, email me.
All right. Have a great
Otherwise,
day.
you have a wonderful day. Thank you, everyone. Bye bye.
Bye.